Okay. All right. I want to welcome everybody to our Forex Profits 2.0 class, where you are learning how to scalp $50 to $100 a day. And like I always say, it's going to be some people that's going to make $300, $500, $1,000, $5,000 a day. Now, this class is to learn at your own pace. You don't compete with nobody. Everybody's going to get it at their own time. We are going into session 4, and I am your master trainer. I'm Angela Powerhouse Williams. So let's get started. Disclaimer, I'm not your financial advisor. I will not tell you what to invest in, nor pick stocks or trades for you. This training is for educational purposes only. Please be aware that all trading transactions can result in potential loss, and you should only be trading with disposable income and not leverage more than you can afford to lose. Information disclosure: you may not discuss, share, reproduce, copy, reprint, modify, rewrite, create, publicly display on social media, publicly perform, license, or sell content retrieved or learned from this presentation without the express prior written permission of myself, owner of Financial GPS 360. Okay, before I get into the training for tonight, what I wanted to do is I just want to talk again about making sure that you guys understand consolidation and the box method. And what I wanted to throw in there is what I call the second candle confirmation. Okay, so in this example, price action was consolidating. It was literally moving in this little box. Now, depending on when you come into the market will determine how your box is going to be drawn. Okay, and what the top and bottom is depends on when you came in. Okay, in this example, we have a little box that was drawn. Okay, but what I want you to do so that you don't get caught in a potential breakout outside of the box is you can add a second candle confirmation if you like. So that means that when starting right here, if we look over to the left hand side, you see how the box came up. And then price action is literally stalling at this price point. Okay, so this is obviously a great top of a box. When the bullish candle touched the top of the box and then it closed inside of the box, and then the second candle was a bearish candle, so this will be a red candle, and let's say you start to see a wick at the top of this red candle, that is when you're going to enter your trade to sell. Okay, so don't sell just because it hits the top of the box, because if it breaks out and it starts moving, even though you can have a stop loss in place, why take a loss when you don't have to? Okay, so this is a way to take the risk off of trading the box. Okay, so if it's truly consolidating, price action it's going to go to the bottom of the box. At some point of time, it's going to hit the bottom of the box. So in this case, we got a red candle right here. So that's pretty much confirmation that the price action is going to go at some point and visit the bottom of the box. So you literally could get into the trade at any point up in here. You can go in the middle of this red candle. You can wait to the third candle and just jump in, but you know you're going to be doing a sale, and you're literally going to hold it open until it hit the bottom of the box, and then you're going to close out your trade. Okay, again, price action pushed up, and it's literally a repeat over and over again. So you enter for short, let it go to the bottom of the box. When the candle touches the bottom of your box, go ahead and close out your trade. Because if the market is truly consolidating, again, it's going to reverse back out, reverse on you. Even though, as you can see, this candle pushed way back up. But when it pushed down, but it hit the 21. Remember, when the markets are trending in an uptrend, it's always, when it pulls back, it's going to respect the moving averages. So it will always reverse and push up from a moving average. So that's why this ended up going down and coming back and being a long wick, and it started to become bullish because it's respecting the 21 moving average, even though it's still in a trending market. So you could do a buy. Oh, well, let me do all the sales. So here you could short. It's going to go to the bottom. Here's another example. Price action went to the top of the box. You seeing rejection. You seeing wicks coming out the top of the box, red candle. You can short right here, hold it open till it get to the bottom of the box. Here's another example. Same thing happened. Bullish candle went off the top, came back, closed within the box. The next candle opened up, it pushed out a little bit, then it came down and closed, still in the inside of the box. You can enter here for a sale, holding it open for it to go down to the bottom of the box. So this is just something that for people who are deciding to trade in consolidation. I don't, but if you do, if you want to lower your risk, you can do a 2 candle confirmation. Okay, so the first candle that hit the top of the box, the second candle after that has to be a bearish candle. It has to come down and close in the inside of the box. You can short off this candle, even though it pushed up, it is going to come back down at some point and hit the bottom of the box, and it did. Okay, same here, price action touched, second red candle, closed, still in the inside of the box. You could short, you're still going to go to the bottom of the box. Now, keep in mind that when you are trading the box, you're scalping. That means you're getting in and you're getting out because you're only trading the top and the bottoms of the box. You're not trying to catch breakouts unless you're lucky and you're actually in the right position when the breakout happens. Okay. Up, second candle down, closed in the box, third candle, it went out, came back down, long wick, go ahead and short, hold it to get to the bottom of the box. Okay, usually 2 candle confirmation, like I said, confirms that it's going to go to the side, all the way to the other side of the box. Out, in, enter, sell, hold it to get to the bottom of the box. Okay, same thing if you were buying the bottom of the box. In this example, price action pushed up, real bullish candle off the 21 moving average, so you know it's going to push up. You could have did your buy right here. You ain't even got to wait to the third candle. You can go right up here because you see this happening with the wicks. Buy, hold it open for it to hit the top of the box, close out. Here, price action went down. You see these wicks from the bottom off of the 21. You can do a buy here, hold it open. Price went to the top of the box, close. Same thing. It just repeated all day long. And this is an example of NAS. Price action went down, came out the box, wicked back in. And see, this is how they catch people. It's when the candles come out the box because people are so afraid of missing out that they assume because the price action went out the box, it's about to break out. That is not true. They do that to take your money. And so people be selling right here and the price action keeps returning back on them because they're not respecting the consolidation. Now, yes, it's going to be a time where you might be in the right position and break out that box and keep on going. Yes, you're going to be in the money. That happened today. It definitely happened today. But I just want to make sure that I give you this detail and add this extra precaution in there just because I want you to lower your risk. And once again, you did a buy here. You're holding it open until eventually price action hits the top of the box and you're closing. Look what happened here. In this example, the last trade that you would have took would have actually been a short trade. Right here. Price action went up, did the fake out, and then it broke down. Okay, remember, well, we'll talk about this a little bit later. We knew that the market was going to pull down at some time today. And so we'll talk about that in just a second. But again, if you're shorting at the top, guess what? Even though you will close, you usually will close out the bottom of the box. In this case, it broke out, came up, retested that 50 and broke on down. So if you're in that position, literally you caught the breakout. And so you were super excited because you got in way up here at the top and you were still in when it broke out the box. Okay. And even if you closed out your position, once you realized that it started to create a lower low, you could have went ahead and shorted and got into this drop at the bottom. Okay, so even if you broke out, you still could have got back in. All right, but if you were in the right direction, This is an awesome breakout move that happened on NAS. I hope y'all caught it because I know I did. Okay. Now, what I want to talk about tonight is I want to talk about resistance and support. And the best way for me to describe resistance and support is like I've done in, I think it was in session 2. And that's basically you're looking at historical price information. So in the past, prices have hit a certain price point, and every time it hit that price point, it reverses. That is a good explanation of what resistance and support is. Okay. And resistance is when the price points is on the top of price action. And we know that support is when resistance is on, when the lines, pivot points are at the bottom of price action. So everybody here should already know what resistance and support is. What I want to do is show you how to draw resistance and support manually. So even if you didn't have the Fib indicator, you still should be able to draw resistance and support. And I'm going to talk a little bit about how I draw what I call critical points. And I'm going to give you a strategy to draw critical points to where you don't have to draw all the lines in the different time frames. Okay. So one of the best ways to be able to identify resistance and support is when you change your chart from candle chart to a line chart. And the way you do that is if you go to the top of your toolbar in MetaTrader 4, you're going to go to your toolbar, and as you can see right here, you see your candle selection if you want your chart to show candles. And to the right of that is what we call a line chart. So what you're going to do is you're going to select a line chart, and your chart will look exactly like this. And so the best way for me to describe resistance and support is resistance is the peaks and support is the valley. Peaks and valleys. If you can remember peaks and valleys, you'll be able to do resistance and support with no problem. Okay. Remember, I told you resistance is like throwing a ball up to the ceiling. It's going to hit resistance. And when you throw the ball at the ceiling, the ball is going to fall back down because of gravity. That's the same way the markets. Everybody have a price point. Everybody who's trading has a profit target. They have an entry point. Everybody that's trading is doing the similar analysis as you. We're all looking at the same price action. We're all looking for the same move. And the more people who are looking at the same move at the same point have the ability to reverse price action when it hits a certain point. So obviously, you know, when price action drives up and hit resistance, a number of things happen at that moment. Buyers who got in low are now ready to use that resistance as their take profit. So they are ringing the cash register and they're closing out their positions. That can cause price action to what? Reverse and fall back down. In the same token, there's people that's looking at the market and they say, you know what, I missed the breakout, but I know at this area of resistance, people are probably going to be ringing the register, price going to go down. So I'm going to short at the top. And when the price goes down, because everybody closing out their positions, that's going to drive the price down and I'm going to make some money on the short. With the resistance, it is where price is high, but it's too high. Nobody wants to buy high. Everybody wants to buy low. So obviously the bears get into the market and they drive the price down. Now, when the bears are in the market and they're driving the price down, they're looking at support lines as their take profit. So when price action hit the support, they're saying, hey, I'm finna ring the cash register. So I'm gonna go ahead and close out my position and I'm finna take my money. Well, what is that gonna do? That's gonna allow the bears, the buyers, to jump in the market because they wanna buy at wholesale. So they're gonna jump in and they're gonna buy at that support level. And when all that clashes in, it drives the prices up. That's how resistance and support reacts. And so what you want to do is just look back in history. And when I say look back in history, you just looking to the left. So you pull up the chart that you have, just look to the left, and you just look for peaks and valleys. So let's draw some peaks and valleys, okay? So I'm gonna start at the top here. And I wanna draw the top of the peak. So this would be a resistance area that I am drawing, just looking at this line chart. Right here, I'm gonna draw another resistance lines. Remember, I'm looking where I can see the high point. So we got the highest peak. So you always draw the highest and the lowest on the chart. Always. That's the highest high and the lowest low on the chart. You're always going to do that. And then you look for peaks and valleys. Okay, so these are all the peaks. This is kind of like a price area where if for some reason when price action comes down and comes up, it gets to this area and it's rejected. It reverses the opposite direction. It goes back up again, tests it again. Don't break through, reverses, fall back down. You see this? This is literally happening. And also, obviously, when we're looking at this, we know that at this moment, the market is in consolidation, but it's still a resistance point. So you draw your line. Now, I want to draw another resistance area because if I look down, I see some peaks. You see it? So literally, if you started right here, this is the current candle. You always want to look to the left. So when you draw resistance and support, look to the left. Where do you see areas where price is literally hitting a point and it's just, it can't seem to break through, okay? So that's a level. Here's another level of resistance. So I'm only drawing peaks, not every peak, but I'm drawing peaks where that area has been tested more than one time, unless it's a high. Okay, because as you can see, this is only hit one time. That's a high. That's why I'm drawing it there. I'm drawing it here because this area has been hit multiple times. I'm drawing this area here because this around this area 1, 2, 3, 4 times it had hit and did a little pullback. Okay, so those are my peaks. That's representing my resistance. Okay. Now I want to draw my valleys, and that's where price action pulled back going down. But for some reason, when it hit a certain price point, instead of going down further, it reverses and go back up. So you see that right here. Okay. And again, if you're looking at a chart, you know this is consolidation, but it's still this valley, which is the low, is still a support. I'm gonna draw this one here because it seemed like it hit this area 3 times and it hit here, went back up, came back down, reversed, went back up, came back down, reversed, went back up. So that's a support area too. Price action will respect these areas. As you draw them out, you're gonna look at this happen in front of your eyes. You're gonna be like, kind of know what the market's doing. We got another one here. Price action goes up, it came back down. When it hit here, reverse, came back up. In this case, it came back down, but it broke. It broke. Tried to retest it, and then it fell back down and created a lower low, okay? But again, we pushing back up, broke out. Then it reversed, fell back down, went back up, fell back down, went back up, okay? And that's what's happening here is this price action is going down to retest this level again. Either it's going to break it or it's going to reverse and it's going to go back up, okay? Now, what I also want to do is make sure that I catch even the tiny ones. Here's another one. It goes down and then it reversed. It went down, reversed. That's twice. It went up and came down, reverse, came down, reverse. This had happened multiple times. So this is a support area. I'm drawing a line. And then I also want to draw the line at the lowest point. So we got a line at the lowest point, we got a line at the highest point, and then we go in between with the peaks and the valleys. So again, the easiest way to learn how to draw resistance and support, if you are a beginner and it is confusing you, change your chart to a line chart. Draw your peaks and valleys, your highs and your lows. After you do that, you can click the candle logo again and it will reverse back, okay? So this is what I want you to pay attention to, because this is powerful. Look at your resistance. You got a resistance right here, and you got a resistance on the fib. Now, 9 times out of 10, if you were to look at this on your MetaTrader 4, this is probably a red box. It's probably a red box. That's your 3 confirmations for a potential what? Counter trend. I don't have the RSI on this example, but I'm pretty sure the RSI has went outside the sale point. And so this is literally giving you confirmation off of a resistance points that you drew, that you are in a position for a potential counter trade short to the downside. Look at the bottom. Here's your support. Here's your pivot. There's probably a green box that would be down there as well. 3-step confirmation that it's okay to do a counter trade. You are in a high probability that your counter trade, when you buy low, is going to work. So literally, had you buy low here with your 3 marks, look at all the money you got, even if you just held it open. Now, obviously, remember, they don't go straight up. They got to go up, do all this nonsense, make you take profit, go up, come all the way down, make you rethink, get out with a loss, and then they shoot right up exactly where you thought they was going to begin with. Remember, that's what they do. That's why when we get in trades, we want to get in trades at the highest or the lowest point, so we give ourselves a chance to see if the trade is going to ride out, and we're able to pick up 100, 200, 300, 400 pips. Okay, that's why I only counter trade extremes. I don't counter trade where I don't have 3 confirmations. Okay. When you click to go back to a bar chart, this is what it's going to look like. So these are your resistance and support that you drew using your line chart. And now it's a candle chart. And if you look at this, if you didn't have, one thing about me is when I first learned how to trade, I learned how to trade just using solely resistance and support. I was a price action trader. I was not using moving averages initially. I was just doing price action. This right here is all I need to be successful in trading. That's it, that's all. But it takes skill set and it takes major discipline to be able to trade this and take advantage of it. Okay, but this is what it looks like on a chart. And as you can see, these price points hit big time. Every time it hit a price point, it reversed. Every time it hit a price point, you see it? Price action, if you go to the left-hand side, price action came up, hit your price point, price action fell down. You could have closed right here, or you could have held it open because you got in up here. It went to this support level, closed out, reversed. You could have did a buy from the bottom, held it up. You could have got out here, or because you got in so low, you still got time to see what it do. It pulled back, created a higher high, and pushed straight on up and went all the way up here. Okay, but again, it takes patience and being able to not get pulled in by the noise of the markets when they're trying to confuse you. Okay, and so price action here, your support, your resistance fib, which is giving you count. This is letting you know that you're drawing your fibs correctly because it is falling on the fibs that are automatically being done for you. Okay, that you can test your skill level out. Reverse, it fell back down, it's going up. We in this little channel, it broke down, it's going to always go to the next fib, come down, come up, come down. That's all price action does, is go up and down between resistance and support. Now, when you're trading resistance and support, especially if the market is trending, I want you to always have in your mindset, be prepared to take a scalp trade. And a scalp trade is when you get in and out. Now, if you can satisfy the 3-step confirmation, you may hold it open just a little bit longer to see if you can catch a real breakout. Okay? But if it is not, if you do not have a 3-step confirmation that we talked about in the prior lessons, then that means that you treat it as a scalp. Again, in, out. So for example, if the markets are, the overall trend is up, the market is in a uptrend. Price action is pushing up. The candle pushes, touches and pushes above this resistance line. And then it starts to wick. And then when it closes above the line. And then a red candle starts to form. Now, for most people, this is how they are scalping. So a scalp means the expectation that when price action hit a resistance level, especially for the first time, the natural instinct, thinking about gravity, ball hitting the ceiling, is going to fall down. So you can do a quick scalp from the top. You need to have a stop loss above of probably, like I said before, anywhere between 14 and 15, 16 pips. Okay, because it might push way out on you. You never know. But just to be on the safe side, if you're going to do a quick scalp counter trade off of resistance or support, make sure you got your stop loss set. Okay, and so you'll go in with a short. And what I mean by doing a quick scalp is that means that whenever the market is trending, when price action does do a tiny pullback, it's usually only going to pull back to the 8 moving average and then continue the trend. So again, be mindful of the trend that you're in. If you're in an overall trend and on the 5-minute chart, you in an uptrend, know that if you do a scalp counter trade that does not have a 3 confirmation, you're in and you're out. As soon as it hit the 8 EMA, close out your trade. Okay? The only time you would leave that trade open is if you got a 3 confirmation counter. So, because that means you are trading extreme highs and you're trading extreme lows. It's more likely when it pull back to pull back below the 8, go back and retest the 21. That might be an area of taking profit, or it may go back to the 50 on the 5-minute chart. Okay. But again, if you don't have the 3-step confirmation, in and out, you're out when it hits the 8 EMA. What you also may see is that in the uptrend, price action goes up and they do what we call the little rope-a-dope. And that's when you know this resistance area here, and you just know they're going to hit that resistance area. And you just waiting for them to hit that resistance area. And instead of them hitting the resistance area, they stop about 10 pips before and reverse down on you. And you miss out on that opportunity to get you a quick scalp. So always be prepared to understand that it may touch resistance or it do 10 pips to resistance, and then it's going to fall back. Okay, so you might see it. I call it the fake out rope-a-dope. They do that. I see that quite often. So I want to make sure that I bring that to your attention. It don't always have to hit the resistance. It has to come close to it. Same as if you're looking at support. Okay. Price action is going down. It's going to touch the support line right here. Okay, so it comes down, it might cross support, and then you may get some wick. You might get a long wick. Never ignore candles that are trending and giving you wicks. Anytime they're giving you wicks, after a trend, there's usually some form of reversal that starts to happen. Never ignore it. So when you see a candle that's wicking, you see how it's wicking right here? Don't short. When the next candle open, don't short. Respect that wick, because you probably are short and it's going to pull back on you. All right, respect the wick. So in this case, price action went down. It started to wick, which let you know, okay, price action may be able to reverse at this support level. I might be able to jump in and do me a quick scalp and counter trade. That's what ended up happening. Okay. Keep in mind, the same thing can happen. Price action can go down, get within 10 pips of your support line and reverse on you and do the same move. Okay, so sometimes we be waiting for it to hit that line and then it don't, and we miss out, but just understand that they do that. So it should not be surprising to you. And as you can see, lower price is rejected. Okay, so this is how, if you want to do a quick scalp, as soon as price action hit a resistance and support for the first time. I do not do this. Sometimes I don't do it if it didn't hit multiple times, and because usually after multiple times, usually after third time, it usually break through, but you never really know. So again, this is the psychology behind quick scalps. Okay, and so I'm gonna go in a little bit deeper and even give you an additional trade strategy for if you want to do a counter trade, quick scalp, but you want to lower your risk. Okay. So here's an example here. What is resistance and what is support? We got it right here. So this is a perfect example of a resistance area. Okay. There's some support here too, but I just want you to see what a resistance zone will look like. It looks just like this. Up, fall back down. Up, fall back down. Up, fall back down. Up, fall back down. Kind of predictable. So you got 1, 2, 3, 4 scalping counter trade opportunities right here. Here's a support area where it's multiple times where these candles hit this price action, and when it hit it, it pushed up. Okay, as you can see, obviously this is a consolidated market. It's literally moving sideways, but the same applies. Shorten from the top, buy from the bottom. If you're looking at this and I wanted to draw support, here we go. It's at the bottom here. Every time price action hit this, it pushes up. Every time it come down, hit here, it pushes up. Respect these wicks at the bottom. These long wicks at the bottom of a candle near a support line is letting you know that lower price is being rejected and there will be a potential move to the opposite direction. Okay, so don't be shorting when you're seeing wicks. Don't do it unless it breaks down on its own and break through. Other than that, don't chase the candle. Respect the wicks. Short, right here. And these didn't have big wicks, but it kind of moved sideways. Price action pushed down. Then it pulled up. Then it pulled down, tested it again. And then price action pushed up. And again, I probably could have drawn a line across the top here as a level of a resistance where you could dig in and out almost like a box. And then obviously price action eventually broke up and broke out. Okay, so I just want to make sure you understand how to draw support and resistance. Now, let's talk about how to trade support and resistance when the market is trending. Okay, remember what I told you, how the market When it's trending, it might pull back to the 8, the most the 21, and then it will continue the trend. So if we are looking at resistance, okay, in this example, we are clearly in a uptrend, okay? So price action hit the resistance, then it broke down and it did a pullback. But when it pulled back, it didn't go all the way back down here. It did a small pullback, and this is probably the 8 or the 21 moving average. And then price action reversed, and it started to push back up to do what? Retest this resistance area. Now, when it retested it, it broke through and it closed. Now, some people, just because the price action broke through, they tend to go ahead and go long. The candle broke through the resistance, I'm gonna go ahead and I'm gonna do a buy. Okay, that's not always the truth. Okay, sometimes you can get caught doing that. So what I want you to do so that you can increase your probability of winning is that the only way you would do a buy with a break of resistance is if the resistance is breached, it is retested, and then you have bearish, bullish candle confirming the move to the upside. So price action pushed up. I'm not going to hit buy. I'm going to let price action come back and retest this. I want to see if it retests. So it retested and it broke it, but then it came back and closed and gave me some wicks at the bottom. Woo, I love to see wicks. Okay. It went up. It came down again. Rejected, turned, gave me some more wicks. And so what does that mean? Now I got a higher high. So if you look here, this was a low. We got a higher high, we got a higher low, we got a higher high, a higher low. Now the market is trending. It's trending to the upside. It is a strong possibility that it will continue to go long off of this area. And what happened is you end up with a bullish candle. I love to see a bullish candle with a wick touching this resistance area. And then I'm going to go in with a buy at that point. And it will continue to trade on up. And so what it did is it broke resistance, retested resistance, and then rejected resistance. And once it rejects and start create higher highs, this resistance actually turns into support. It's no longer a resistance area. It is now a support area. Okay, so again, if the market is trending, it hit a resistance, you can do a quick scalp to the downside, get out when it hit the 8 or the 21 moving average. Usually it will continue the trend that it was originally on. So price action will go back up. It's going to try to retest. Sometimes price action will go up and go down and retest that same area 3 times. Usually after the 3rd time or on the 3rd time, there's usually a break and then a continuation of a trend. But like if you was looking at NASDAQ, they was doing long consolidation retests all day long, and then it broke out, okay? And so in this case, you wait for the retest, wait for bullish candles, wait for wicks at the bottom of the candles, because that's telling you that they don't want to go down. Then you enter for a buy and then wait for the continuation of the trend to the upside. Okay. And so the opposite happens when you are in a downtrend. Okay. So the market is clearly in a downtrend here. It hit the support, it broke support, and then it created a wick off the support line. And then there was a bullish candle. That's a quick pullback. This is an opportunity for you to do a quick scalp. You're getting out when price action hit the 8 moving average. Okay. And then price action will usually wick off of the 8 moving average and continue to fall back down and do what? Test it again. So what we're waiting for is we're waiting for price action to retest support, break it, move down, reverse, come back up and test this support, and then start to reject it at this level. And once it starts to rejecting at this level, we're going to go in for a sell entry to continue the trend on down. Okay, and if you sit and study and look at the markets and look how the candles reacts to resistance and support, you're going to see where you could have did a quick scalp, and then you're going to also see the market break, retest, and then go into the continuation of the trade. So again, I want you all to be able to be profitable in your trade. Counter trading is always risky because you're taking a trade against the trend. And I always told you the trend is your friend. I'd rather you be trend trading than counter trading. But it is important to me that you understand how all of it goes so that if you do decide to take a counter trade, you increase your probability of getting a win. Okay, so you can use this support and resistance for increasing the number of positions that you have open for a particular trade. Okay. So let's say, for example, the market was in an uptrend. You got a support area here. This support area is a resistance line that you drew. It's a line of resistance from your Fib indicator. Is also a red box. So you got your 3-step confirmation. So you decide, I am going to take this opportunity and do a counter short. And so right here, you see this wick of the candle below this resistance line. And then you see this red bearish candle start to form. And you say, I'm going to hit sell because all my 3 confirmations is in. I feel comfortable taking a counter trade to the short side. So you hit sell. Now, your take profits is going to always be other resistance and support lines in the direction that you are trading. So this is a resistance line. This will be a support line here. This is a potential take profit. But remember, you got in at the top. So you have a little bit of time and a little wiggle room to see what price action is going to do. Okay, so price action ended up breaking resistance. It came down and then it did the hook, and that's the pullback for the retest. So it did the hook, pushed up, it broke this support line, got you some wicks. You like, okay, I'm gonna leave it open because remember I got in up here. So worst case scenario, if it started pushing up and it got to a halfway point, you might want to close out with some money. Don't let it go all the way back to where you got in and now you losing. That don't make sense. Get your money because you can always get back in the position. Okay, so you held it open. It's right here. You got some wicks. Okay, you feel more confident on leaving it open. The next candle push up, you got another wick. Then it turned into a red candle. It broke this support area, came down, closed below support. You're in the money. Candle open, and then it retested. It went up to try to retest this area, and then it wicked. Now you know, oh, it's going to go down to that second take profit level, leaving my trade open and go, 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 go. Now you at the second support level. All right. Now right here, when this candle rejected this level and continued to wick down, you could have entered another sell position. So you had your original sell position at the top. You could enter another sell position here. Okay. It went down. It broke this level of support, came back up. We got some wicks here. Next candle, wicking from the top. I'm going to leave it open. Let it go down. What did it do? It broke the support again. And what is it going to do? Eventually do a hook. Go back up and retest. Once you got your rejection here, you enter another sell position. Shorten it down. Always, you can take profit here, or because you got in so far up here, you can give it a wiggle room. So that means that wiggle room to me is when you let the candle go to at least halfway point of the previous candle. If it go past that, I usually close out and take my money. I ain't finna play with them people. I want all my maximum money. I can always sit back and wait for another opportunity to get in and get more. Okay, so in this case, it fell back down below support, came back and retest, reject, another sell open, pulling all the way down. Okay, and you can hold it open to the next take profit. I say at least when it does at least 3, it's probably going to start reversing. So you after 3 take profits areas that have been breached, I usually look at ringing the register and sit back and wait for a counter trade to happen. Okay, so this is a very less risky approach to adding multiple positions. What you may also see is you may see people who are at the extreme levels, they may put in, instead of scaling into additional positions, they'll do 4 or 5 right at the top. And those are for people who have bigger account sizes and you can risk that. Okay, but many will do 5 right at the top, right at their entry, get and obviously if it broke down this, you caught a whole bag. Okay, so people take different ways that they add additional positions. So you can do it all at the top, or like I said, if risk or you working with a smaller account, I would rather you wait for retest and then enter multiple positions. And what you can do is when you first start off at your lowest lot size. And then as you increase your positions, you can up your lot sizes because the moves may not be as big as the original. Okay, so I hope that gives you all some clarity on how to use multiple positions when you catch a breakout. Now, what I also want to share with you is I want to share with you what I call some hacks. And this is just for me looking at the markets for a long period of time and looking how the candles reacts to resistance and support. I start to get an idea of what could possibly happen when I see it. And so when I see candles, let's say we're in a uptrend, okay, we got the resistance area. What I have found is whenever a bullish candle break resistance and it gives me a long wick and the body closes underneath the resistance line, I usually immediately jump in with a scalp to the short side. I do not wait for second candles. I don't wait for retest. Usually when I see this move, I got an 80% chance of being right. Okay, I got an 80% chance of being right. And even if I'm wrong, literally I'm going to have my stop loss right above this wick area anyway. So if I'm wrong, it's going to take me out the trade and I'm only going to have a small loss. And then I can wait for my setup again and then make my money back. Okay, but when I see this, and you can watch this on your screens, you see a candle and it's on resistance. If that body closes below a resistance line, 9 times out of 10, 8 times out of 10, the next moves are going to be to the downside. So you're going to be in the money at some point in time on that counter trade. Okay. What I've also noticed is that whenever I see large, big, long engulfing candles, it's always a setup. Sometimes, now don't get me wrong, it's not all the time. Majority of the time it's a setup, and then sometimes it actually can represent a parabolic move and price action just keep going up and up and up, but that is very rare. So most of the time when you see a big gigantic candle and the force breaks that resistance, that's because people are waiting for it to hit a certain price target and they finna jump out of there. And so usually what happens is when I see something like this, normally it pushes down. You can literally get ready to scalp down and not buy. Instead of buying, wait for the opportunity to short, because it's usually going to short back down and then start a retest. Okay, so when you see a big gigantic bullish candle break through resistance, look and see what the next candle after that be. It's probably the opposite color going back down. All right. Something that I've also noticed is if the markets are really slow and the candles are moving, they're trending, but they're small candles. Like it's really slow. It ain't no big engulfing candles. It's small candles just trekking up the hill, just trekking up the hill. When you see that, don't scalp. Don't do a counter trade. Just sit still, because 80% of the time that's going to be a trap. And I'm going to tell you why. Because normally when candles start to get smaller in size and they start to lose their momentum, when it hit resistance, sometimes it'll reverse and break down. That also could be an identification or alarm of a potential reversal. I have found when the markets are really trending, especially when you are in NAS, when this happens, it's going to start moving in consolidation. So it's going to literally hit resistance and then start moving to the right. And after it goes and moves right, it's going to continue to trend. So instead of shorting, when you see this move happen, just sit back and wait. Draw your box and then wait for the breakout. Okay, so 80% of the time, when you see it slowly trekking in one direction, it almost looks like it's gonna keep falling up. The candles are real small, and it look like they're gonna keep falling down, falling up. But every time you look up, it just keep going up like a little turtle. That's a trap. Don't counter trade. And the same is true again when you are looking at support. When the bearish candle come down to the support level, and then if it starts to wick and the body closes above the support area, I usually go in with a quick scalp buy. I got an 80% chance of being right. So what does that mean? There's a 20% chance I'm gonna be wrong. That's where your stop loss comes into place. It's okay. All right. Here's another example. The big old red bearish engulfing candles go down, break support. And what people do is they're short because they like, look at that big old candle and I don't want to miss out. I'm finna short. And instead of the price continuing to go down, it reverses on you and goes straight up on you. Wait for the retest. Okay, so let it go ahead and go up. Let them play their games and come back down. Let them come back to the support area and test it. If this becomes rejected, then you short. Here's an example again of price moving down little bit by little bit, little bit by little bit by little bit. And then it goes into consolidation and then it breaks out. So in this case, the smaller the candle, they just trekking and trekking down. Don't even try to get in for a reversal because number one, it's probably not enough volume to push it in the opposite direction. So 9 times out of 10, it's going to keep free falling. So don't try to counter trade when you see this move happen. So this is just some things that I've learned by just looking at the markets and looking at how the candles work, where I was kind of like, I get it now. And then I started to realize that big money put all type of traps in place to trap dumb money, so that they can get your money and you can't get none of their money. And what I found is if you patient and let them do their thing, eventually in front of your eyes, you will see exactly what they fitting to do. And then you can put yourself in position to profit off of it. So let's talk about my daily chart analysis. And so what I wanted to do is I wanted to share with you pretty much how I draw what I call critical points on my charts using the daily, okay? And so the first thing that I do before I even trade for the day, before I even think about jumping in the markets, I'm gonna look at the daily chart, okay, for whatever asset that I'm gonna use. Everybody know I trade NASDAQ more than I trade anything, because I'm also trading it on the future side, and it just makes sense for me. I love trading tech stocks. I know the most about them. I've researched them the most. So you stay where you're good at, and all you got to do is increase your lot sizes to get more money. It's real simple. You don't have to be all over the place. Master one thing. So I'm going to pull up my daily chart. And the first thing that I'm looking at is I'm looking at the last two candles. Okay, because I know that the last candle right here represent today. So this is today's candle because each candle represents one day, 24 hours of price action. But I'm looking at the last two because I always want to know about what it looked like yesterday, because what it looked like yesterday can help determine what it may look like today. All right. So when I look at these two candles, the first question that I'm going to ask myself is, where are these last two candles in relation to the moving averages? Are they above all the moving averages, below all the moving averages, or are they in between all the moving averages? Okay. And based on that, I would know what the overall trend of the market is. You always want to know what the overall trend, because the overall trend will dictate what will happen throughout the day. Okay, so I want everybody to sit in the chat box right now, based on the last two candles. Are we in the uptrend, downtrend, or are we moving sideways? Good, Val. Go on, Val. Go on, Clyde and Ricky and Sandra. Go on, Damon, Shaid and Rochella. Yes, yes, yes. Go on, Sandra. I'm so happy for y'all. Yes, you are in a uptrend. Good job, Derek. Okay, so what I'm doing is, when like I said, when I print out my cheat sheet, I'm going to write down what the overall trend. So the overall is up. And what that means is, even if the market is going down, it ain't going to go down to the bottom. It's going to go down and retest the moving averages, and then it's probably going to push back up. Okay, because I'm still in an overall uptrend. That means I'm buying off 8s, I'm buying off 21s, I'm buying off 50s, because the overall is an uptrend. But I noticed something, because I look at the last two candles and I see, are the last two candles reversal candles? Okay, so if you go back to the candle training from last week, you'll know what you're looking at. You see a doji. You see a red doji the day before. So what does that mean? Even though I'm in an uptrend, I'm looking for price action at some point of time today to move down some and do a pullback to either the 50 or the 200. That's what I'm looking for, because that doji represents potential reversals. Now, big money know that people who know how to read charts know they're looking at a doji, a long leg one at that, right? And so what they got to do is they got to mix you up. And so they know that you're looking for the market to short today. So when the stock market opened at 8:30 this morning, they know you were looking for the market to pull back because it had got to a point, right? So what they do is they try to confuse you. So what they did is, instead of dropping the market immediately at open, they pushed it up. They pushed it up. And they're pushing it up because really they want you to get your mind off of where they probably are going to go today. So what did they do? They pushed the market up, and then they dropped it down. Okay? And that's why we got this wick here. That is why the markets today, if you notice, in the morning time, price action pushed on up. It created a high, right? And then it went into consolidation, and it was stalling. It was chopping people money, because everybody assumed that price action was going to go up, do that consolidation, and break up like it always been doing. This is NAS. Everybody was looking for that. But if you read the charts, you know, okay, they trying to trap people. So that's why I was in consolidation so long, grabbing people. People, I'm telling you, I bet you it was so many people in buys today. And then they like, I got them. And then they're going to go and do what you knew they was going to do, because when you looked at the daily, you know you saw that doji. Every time you see a doji on the daily, the next day goes down at some point in time. You just got to be patient and wait for it. And that's exactly what happened. Okay, so this is what the daily is going to tell you. It's telling you the overall trend. And it'll also tell you when a pullback could be possibly happening, so that you know that when you are trading throughout the day on your 5-minute, you know that there's going to be a pullback. Even though the overall trend is up, it ain't falling to the basement, but you're going to get a pullback to the 50 or the 200 probably. Okay. And that's probably exactly what happened. Okay. So now I know what my game plan is. I know that the overall trend is up. Okay. So I'm not going to short off of moving averages. If anything, I'll be buying off of moving averages. But I see there's a doji, so I'm looking for a down move. It's probably going to be a pullback to the 50 and the 200. So I just want to get a really good position so I can short from the top. All right. So if you sit back and wait for them, sometimes they just drop it for you. Majority of the time, they do the opposite and then drop. Because if it was that easy, everybody be trading, everybody be making money, because it would be that easy, but it ain't. Okay. So they got to always make you they got to make you question yourself. And because you are emotionally tied to a trade, you overthink. And you jumping in and jumping out like, I don't know what it's going to do. Then you get frustrated. Then you don't do nothing. Then you come back 10 minutes later. And now the move that you've been waiting for all day has happened. Instead of just waiting and being patient, don't be in the trade. Wait for them to show you they about to cross. And when they cross, you know that it was supposed to go down. So you'll be more confident in taking your trades. Okay. So that's the analysis. So you kind of got a game plan for what today is probably going to do. It's probably going to break down. The next thing that I would want to do is I want to draw what I call critical points. And I'm going to show you how to draw these critical points in a way so that you do not have to draw additional critical points on a 4-hour or a 5-minute. Okay. I'm going to show you how to draw it so that you will have intraday resistance and some critical points as well. So what I'm going to do here, and this is on the daily, I want to probably look at the last 10 candles. Oh, I forgot to, don't pay these no mind. But anyway, I want to look at the last candles, last 10 candles, especially candles from, here. Remember the daily, this is a big old move. You see this up here, this is 15,692, and you see this way down here, 14,770. Price action ain't finna fall to that in a day. Okay. So we're not necessarily worried about it, but I'm only looking at the 10 because it's easy to pull up the daily. Because when I pull up this daily chart, these candles go all the way back to July. I'm not trying to draw resistance and support back to July. What I'm trying to do is I'm trying to identify critical points of price action in the last, maybe in the last 5 to 10 days. Okay. So I'm looking at a 2-week window when I'm looking at my daily, okay? And what I am doing is I'm literally drawing the highs and lows of each candle. So I'm the top of the wick, the bottom of the wick of each candle for the next 10 candles, all right? Or at least to the 21. You can do to the 21 or you can do to the 8 because, again, that's a big drop. That's a 300-point drop, all right? So let's do it so I don't confuse you. So just look at the last 10 candles. So I don't want you to be looking at all of this. Just look at these last, just look at the last 5 to 10 candles. This is a good enough move for me. And I'm just going to draw tops and bottoms of each candle, literally. Here's the top of this candle. All right. So if I was drawing this, getting ready for tomorrow, that's the top. Here's the top right here. Here's the bottom, the top and the bottom of these last candles. How many candles? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so this is 10. So these are 10 candles, top, bottom. And now I'm finna go in between here and I'm gonna draw my lines from wick to wick. Now I might not have did all of them in this example. I was trying to. I might have missed some, but when I show you what it looks like when you go down to the lower time frames, I went in MetaTrader 4 and actually put them in there the way I would do it. So I did the high, I did the low. This was the obvious support area, lower of these wicks. Okay, so high, low, obvious. I'm going up here. I'm getting the top of this candle wick. I'm getting the bottom of this wick. I'm getting the bottom of this wick. I'm at the top and bottom of this wick. I'm at the top of this wick. Okay, it kind of looked like this. When you put it all together, it looks like this. And this is on the daily. So I'm literally drawing from, I'm getting the top and the bottom of each candle. Top and bottom of each candle. Okay, and I think I put some more up in here too. Like I would have did this here too. And you can do this, so you can go all the way down. The main important thing is that I'm drawing them at least to this area, because this is almost 400 points. Okay, so obviously the daily is big price moves. Okay, so I can just look at the last 5 candles if I want to, and just do the high and the low, and these are my critical points. And what you're going to do is when you draw your critical points, change the color of the lines. Make sure the lines is not any other color that you have on your charts, so that you know that when you see it, you are looking at a critical point. Okay? If you do this exactly how I'm telling you how to do it, just look at the last 10 candles, mark off the highs and the lows of each trade day. The high and the low of each trade day. That's all you're doing. These are money points. These are money points. Whenever price action hit these points, it's going to automatically reverse in the opposite direction. And depending on how strong the move is, this can also be a swing trade where you literally can go in and hold it open probably for the whole day or a couple of days and catch a whole bag. But I don't recommend swing trading until you have a big enough trade account. Okay, because remember, this is a daily. A lot can happen in a day. Okay, but these are critical points. So if you're scalping in lower time frames, you are always going to be in the money. That's all you got to do. So this is off of the daily. Look at the 4 hour. I don't have to draw no lines. My critical points from the daily is moving right down in the 4 hour. You don't even have to look at the 4 hour no more. What I'm teaching you, you don't have to. Look at the hourly. Now I know there are some of you who trade off the hourly. Look at my critical points. Money. Money. My points always hit. Always hit. And just trading pure resistance and support. When price action hit this, here's a critical point, and it's on top of a resistance fib. That's your confirmation, baby. It hit here. What you doing? Shorting. You short. Do a quick short scalp. It's right here. This money. 705 to 687. That's money. It could be small moves, y'all. It's just understanding resistance and support and respecting it. Okay. If we look over to the left side, price action pushed up. It broke my critical point. It broke it. It broke it. And it kept moving up. Came up, hit my second critical point. Close out. What did it do? It reversed and reversed back down. So sometimes it will break it. It will. This is a big old bullish candle. Instead of breaking further down, it came back up on you. Okay. You still, if you short it from up here, you still got time to see what this is going to do. And it ended up breaking on down, breaking all the critical points, coming on down, because when it breaks critical points, it's usually making its way to test some moving average. It went to test the 50. It went to test the 50. Okay. And then it started to push right back up. All right. Now, what do these critical points look like on a 5-minute chart? Money. Still money, right? This right here, when they moved up to confuse you. And remember what I tell y'all about these big old bullish candles, that they do this to throw everybody off. People saw these bullish candles because it kind of looked like it's parabolic. Look, it went up it's only one candle and then another bullish candle. That's parabolic. So they did this in particular to throw everybody off. So that when you looked at that daily and you was like, I just knew that the market was going to pull back. I guess not. It's finna go parabolic. I'm finna buy right here. I ain't missing this. I ain't missing this. And you do your buy right here. And you mad now. You mad because you done lost some money. Because number one, you didn't know that trick I just told you about today with them big engulfing candles that break resistance or support. But you didn't understand that they need to come down, but they need to play with you. Now, your critical point is on a resistance, and it probably should have been in a box, a red box. So you would have been comfortable doing a counter. They ain't paying attention to the people countering. They paying attention to the people that's buying. Dumb money. So literally shorting here is at the highest point you could possibly be at the point. Not saying it couldn't push up higher, because it could. It could have started going parabolic. But because you got 3 confirmations, you are okay. If it's wrong, it's okay. You got your stop loss set up at 14, 15 pips. Get out. Don't stop leaving stuff open and hoping it come back to where you need to. Just get out and you can get in and sit back and get in the right direction. So shorted here, price action pulled all the way down, came back to retest the 8. And I told you the overall trend is up. So when it come back and touch a moving average, 9 times out of 10 is going to push up a little bit off of it. And it did. And then it came back down to the 8 again, came and retested 21. We're in the overall uptrend. So 9 times out of 10 is going to push back up, and it did. And then it started coming back down to 21 and came back up again. So now you know you in a box. The market moving sideways, it ain't doing nothing. You just going to draw your box. That's all you're going to do. And then you're waiting for them to drop the market. You're not waiting for them to go up, because you know what you saw on that daily. Always remember what you saw on that daily. Write it down on a piece of paper, put it on the wall. Whatever you need to remind yourself with the overall trend, and if you saw a reversal candle, so you know what they're going to do. So in this case, it broke out the box. It went to the downside, and you should have been in a short if you wasn't in the short up here. So you caught the breakout, price action went on down. And remember, when it's a reversal candle on the daily, 9 times out of 10, when it come back down, it's going to come down and it's going to at least test the 200 on your 5-minute chart. Okay, that's what happened. It tested the 200 and then it did a little push up, but you've been in since here. So you all in the money, or you in right here. You're still profitable. It came up and it paused less than halfway of this candle, and then it pushed back down. Stay in your position. Move sideways, pushed up, stay in your position, and it came on down. And in a second, I'm finna show you how you can draw fibs, and fibs would have showed you how far when it fell down, how far it could go, when it could push up, and some take profit potential. Now, what I like to do is I like to draw my daily critical points on a Sunday to get ready for the trade week. But I also modify them as the week goes on. So as critical points are breached, you redraw your critical points. You make some modifications. You just don't leave it there. Create modifications. But I start off with drawing these points on Sunday. Get ready for the trade week. Let's see where the markets are going to go. Okay, modify throughout the week. Okay, now you may hear a lot of people talk about Fibonacci ratios. Okay, I'm not going into the math of a Fibonacci and how you calculate it. There's 1,001 videos on YouTube that will tell you that. I am not no mathematician. All I know is I know it works, right? So what you got to understand is everything in the universe is based around these numbers. And it doesn't matter if you're looking at the way our scalp goes in a spiral, the way flowers grow, everything in the world looks like this spiral. And literally these Fibonacci ratios make up and represent that. Okay. What you see right here is almost like a number sequence. Okay. You start with 0, you got 1. 1 and 1 will give you 2. 2 and 3 will give you 5. Okay. And this is just adding the two prior numbers together to get the next ratio. 3 and 5 will give you 8. If you go 5 and 8, you get 13. If you go 8 and 13, you get 21. 13 and 21, you get 34. 34 and 21, you get 55, and on and on and on. This is a sequence, right? And so these sequences is going to give us what we call these ratios. And what these ratios is going to do is it's going to help us look at price action, and we'll be able to identify when a retracement may be about to happen. So that means the market is trending, it's going to do a pullback. The Fibonacci is going to give you an idea of how far price action may pull back before it continues the original trend. Okay, so it's almost like the stair step and the paintbrush. When we talk about trending, price action goes up, it pulls back down, then it goes up higher. That's all Fibonacci is doing for you. Okay, so not only can it give you an idea of when price action will reverse, which will give you an opportunity to do a counter trade, but then it also can tell you an idea of when price action is going to continue to trend. So if you miss the breakout, you may be able to re-enter after the pullback and the continuation of the trend. So it's really cool. Okay, and there's an 83% chance that price action is literally going to hit every ratio that you see on the chart. Okay, so let's go into this. Fibonacci is just another tool that you can use for resistance and support. Now, I already give you guys an automatic a Fibonacci indicator, but you still need to know how to draw Fibonacci support and resistance on your own and manually. Okay, and so again, I just talked about how to trade resistance and support. And so in order for you to even go into that, I want you to see. So let's say this is the top of the move and then the market started to reverse down. This is a resistance area. You drew your fib from the top to the bottom. Okay, so price action reversed from this top resistance area. Where is it going to go? 9 times out of 10 to this support area. Okay, this is the 61.8. This is an opportunity for you to take profit. So you can use these as profit targets. You in, it hit the line, take your profit. You can also use it as a scalp opportunity because every time it hits a particular point, it's going to reverse and do the opposite before it continues to trend. That's exactly what you see here. Price action go down, it go up, it go down. That's it. Rejecting areas and continuing to go down. That's what you see. So when you hear people talking about Fibs, they're just manually drawing their resistance and support lines that you already got. Most of the time, you already got it on your chart. Not exactly, but you come very close to it with the Fib indicators that we already have. Okay, but the Fib indicators that we already have don't necessarily identify additional profit targets beyond their ranges. Okay, and we're going to talk about that in a second. So again, price dropped at the top. You can buy at the reversal. Okay, so you shorten at the top, buying at the bottom. Price action came, retest this support, fail. You can short at the top. It goes already down. Buy off the bottom, sell off the top. Buy off the bottom, sell off the top. Buy off the bottom, sell off the top. Literally what we just talked about on how to trade resistance and support. So you can do that if you manually draw it on your chart. You can use them in that type of way. This is if you were trading pure price action. If you had no indicators on your chart, as long as you can draw a trend line, you can draw some fibs, you can still be very profitable in trading. And this is how I learned initially. Now, here's the rules when you are drawing your Fibonacci. Rule number 1, Don't ever draw fibs on a consolidated squeeze zone, sideways, choppy market. Remember, when it's that, all you doing is the box, if you want to trade it. Like I always tell you, for me, I don't trade at all. So when it's choppy, I don't care. I don't care. The only time you should draw, even consider drawing a trend line, the market has to be trending in one direction. So obviously on the right-hand side, we got a low point here, price action, go up, go down, pulls back up, go down, create a higher high, pushes up some more, come down, create a higher high, come down, create a higher high. So obviously you can look at this and tell that the market is trending. It's not consolidating. That is the only time. So that's the first rule. So if you're in the market and the market is not trending, don't draw fibs, or don't even try to draw fibs. Okay, that's rule number one. Rule number two, do not attempt to draw a fib until after a pullback happens. Here's what I mean. Right here, as you can see, price action is obviously trending in an uptrend. Now, right here is the pullback. They call it, a retracement. Okay, so I'm not going to draw this fib until this starts to happen. Do not draw a fib when the market is still trending without a pullback, because your numbers are not going to be accurate. Your numbers will not be accurate. So you want to wait for the pullback. So once you identify a trend and you see it did a little pullback to the opposite direction, then you can draw your fib from the bottom low price to the top. Okay? So again, wait for the pullback, then draw the fib. So first you got to have a trend, then you wait for the pullback. Okay? So in this example, again, if I was going to draw my fibs, I recognize that the market is clearly in an uptrend right here, right? So if it's in an uptrend, whenever you draw a fib, you always start from the left. You always start from the left, even from the bottom left or the top left, okay? So if the market is in an uptrend, you're going to draw from the bottom left, the lowest price point, and drag it up to the highest price point right before it did the pullback. So you're going from here to the left, low to high, low to high. And when you do that, it is going to draw these horizontal fib price points on you. On your chart. And each line is going to give you a number. So you might see 0, you might see 23.6, you might see 50, you might see 61.8, you might see 100, okay? Remember that 100 represents the beginning of where you started to draw your trend. That's what the 100 means. That's the initial breakout point, right? The 0 represents the highest or the lowest point before the pullback, all right? So if we look at this, price action pushed up, trending, it did a pullback, you draw your fib from here to here. Now that you undrew your fibs, what you are waiting for is you're waiting for price actions to come and test these points. So because we're in an uptrend, we're looking for opportunities to get in the trade to go long, because what the Fibonacci retracement indicator is going to do is going to tell me how far the pullback may go before it reverses and continue the trend up. Okay, so as you can see, when it reverses, it hit the first and then it breaks it. So I'm waiting for it to possibly retest the second. It might, or it can start reversing up from this level. So each one of these points, price action can reverse and continue the uptrend at any point here. Okay. Now, if it breaks the 100, all bets are off. If it pulls back beyond the 100, it's probably not going to continue to trend up. You're done. And usually you wouldn't hold it open if you were doing a buy that far down anyway, because you'll have your stop losses in place. Okay. So again, you're looking at these areas where you get the greater probability to do buys so that you can get in the trade and continue it up. Same with if the market was in a downtrend. If the market was in a downtrend, I'm waiting for it to do a little pullback and start creating higher high. Okay, now I'm going to draw my fibs from the top of where the trend broke out to the lowest point before it started to reverse and do the pullback. So I'm going to draw from here and draw here. And what I'm waiting for price action to do is come all the way back up to these price points and see if I can get some scalping, reversing short trades. Or can I be lucky that when it reverses, it comes all the way back down and tests the low? Okay. And so that's how it works. And that's how you draw it. So again, number one, look for the trend. Number two, draw from the high, low, or the low to the high. Do not draw until a pullback starts to form. If you draw it and there is not a pullback, your numbers are not going to be accurate. Okay, so let's take a look at these uptrends. And so like I said, each line represents a ratio. Again, you're going to see 100, 23.6, 38.2, 50%, 61.8, 76.40, 76.40, and then you will see a 100. Okay, and that's on the basic Fibonacci chart. And it may be more on people's indicators. Okay, so again, what is this telling me? I drew my fib from the top to the bottom once this pullback started to happen. And so if I shorted at the top here, I would actually be looking to take profit when prices hit the 23.6. So that could be a profit target area for you. Okay, it can be used in a number of different ways. So that's one way to use the 23.6 as profit targets. All right, so you could close out your position, or you can leave your position open to see if it will break 23.6 and come on down. Usually, if candles are staying in this 38.2 zone, that usually represents that the market is moving into consolidation. And if you wait long enough, it's probably going to break out and continue the trend a little bit lower. Okay, or it could go higher. You never know, so you got to sit back and you got to wait. Now, what I look for, and a point where we call the golden zone, is the 61.8 area. Okay, why do a lot of people wait for a 61.8? Because that means that if you miss the initial breakout to the uptrend, if price action goes to the 61.8 and then reverses and continue the uptrend, you are going to make 61.8% of that move. So you ain't miss out. You're getting a chance to do a re-entry on a trend move that you missed out on. And so 61.8, they call the golden, this is the golden ratio. This is allowing you, obviously, to get in a position at a much lower price. Instead of trying to do buys right here and buys right there, this is the best price. So many people wait for the 61.8. Now, me, myself, especially because I trade the NASDAQ, I look at the 50 and I look at the 61.8. Those two areas are my buy zones. The 50% area usually represents indecision with buyers and sellers. They don't know if they want to continue the trend or they want to go ahead and reverse it down. That's usually a indecision zone. I found with what I trade in NASDAQ, 50% is an area where you'll get a nice scalp reversal and the 61.8. So I look at both of those price points as potential buy entries after I draw my fibs. Now, obviously, if price action go all the way down to the 76.40, you're able to get in on a trade at wholesale prices. You know, if the overall trend is still up, it's still a possibility that even if it fell back this far in a pullback, it still will continue to make its way back up. Okay, so for me, I would do a buy at either the 50 or the 61.8. These are the two areas that I spend most of my time in. If I am using fibs, I will buy off of these areas. Okay, what am I looking for? I'm looking for price action to break come back up and give me some wicks. And when I see multiple wick candles off of one of these Fibonacci pivot point lines, then I'm gonna go in with my buy. Okay. If I don't see a lot of wicks, 9 times out of 10, it's going to go down and it's going to hit my 61.8. And then I'm going to try to go in for a buy as well. Okay. So I don't enter just because it hit the 50 or the 61. I wait for it to show me that it is rejecting lower prices. And then I go in with a buy. So again, this is an uptrend. You're looking at pullbacks. You want to know how far will it pull back before it continue up. I missed this whole move. So that's why I say I don't chase candles. That's why I say let the markets come to you. So one way to let the market come to you when you miss the trade is you can let it come back to the moving averages, and you will find that these pivot lines line up with a moving average. Especially the 50 and the 61.8 is usually the 50 on the moving average. That's why I say sit back and wait and let the markets come back to you. If you draw the fibs, coming back to you is the 50 and the 61.8 range. Then you go in with a buy. And then you're going to put your stop loss below the 76.40, because obviously if it's breaking that, you don't want to be in the trade anyway. Okay. You want to keep your losses short. Okay. Little. And so that's how you do an uptrend. You're looking for 50 and 61. Now you can do any one of them. I know people that is in the class that they trade off of the 23.6. They might take profit at the 38.2. I don't. I wait for bigger moves because I like to be more profit potential. So I like to catch 60% of a move going back to retest the highs. That's what I prefer to do. I like to buy low. Okay, so 50 and 61 is my thing. You decide what works for you and the risk that you are willing to take. If I'm looking at a downtrend, it's just the opposite. I'm drawing from the top to the bottom, but I do not draw the bottom until these moves start to happen, the pullbacks start to happen. You could have did this bottom or you could have did this bottom. Either one of them would have worked because this was a pullback and this was a pullback. Okay, so you draw from the top down. What am I waiting for? I'm waiting for price action to pull back up and go to the 50 or the 61.8 area and reject it. And once it rejected, I want to go in for a sale because I want price action to continue to break down. That's all fib retracement is. It's just giving you an opportunity to see once you miss a trend, once a pullback, when can you get back in and continue the original trend that it was at? And again, if you put your moving averages on these lines, you will notice that these hit probably a 50 moving average. So when I tell you again to wait for the candles to come back to the moving averages, that's what I'm saying. So the fibs and the time frames of the moving averages that I gave you was based around Fibonacci ratios. That's why they are so on the money. Okay, so that's all it is. Your stop loss, again, instead of below this, I want it above the, right here. Here's the 70 area right here. So my stop loss will be right here. Okay, if I'm wrong, because I'm doing a short. So obviously if it's going up here, I don't want to still be in the trade. So to make sure that you have your Fibonacci indicator in MetaTrader 4 set up correctly, okay? All you have to do to draw a fib is, again, you pull up your price chart, identify a trend. Clearly, we're in a downtrend, okay? There was a downtrend and it started to do a pullback, all right? So you want to draw from the high all the way down to the low before the pullback started to happen, right? And so what you're going to do is you're going to go up in your toolbar, and on your toolbar, you're going to see this little button right here. It looks like little horizontal lines, and you will see an F in the lower right-hand corner. This is your Fibonacci tool, okay? So when you literally click this button, it's going to give you the tool, and all you got to do is go over to the top and drag it down. And when you release it, these lines are literally horizontal lines are going to show up on your chart, and you're going to see your ratios to the right. Okay. And so again, obviously from this example, price action went down. It did a pullback. Instead of chasing candles, I'm going to wait for a good opportunity, wait for the pullback. I'm looking at my 50 to 61.8. This is my zone for where I will short the market for the markets to continue the downtrend. Okay, so this is where I'm shorting, market pushing down to do what? Retest the lows and possibly continue to break down lower than the lowest point. Again, if the market is choppy, don't draw it. Now, if you look on your toolbar and you do not see your Fibonacci button, all you have to do is look up at the left-hand side. There is a tab right before this chart. And so it is called inserts. So you're going to click on the insert tab, scroll down to Fibonacci, and then you're going to select Fibonacci retracement. And like I said, there is a number of different Fibonacci tools that is there. There is a number of different Fibonacci strategies. I am just teaching you retracement and how I use retracement. So I am only looking for opportunities to enter a trade, trading with the trend after a pullback. And I am using Fibonacci to decide when is the best opportunity for me to get in to make the most money possible. Okay. So when you go to your Fibonacci retracement tool, it's going to pull up a window here and you're going to see Fibonacci levels. And on this right-hand side right here, these are the levels and the description I want you to have on your indicator. And so when you do this, you're going to see some fibs here by default. So many of the levels here on the right-hand side are already in your Fibonacci level. It's already there by default. So the first thing that you're going to do before you worry about the levels and the descriptions is change the style. I got mine set for a yellow line. If you want your line to be any other color, change it. I like my lines to be thick. If you want thinner lines, because you have other stuff on your chart, here's the area where you can decide whether or not you want a thin line or a thicker line. Okay. Then the next thing you want to do is you're just going to hit the scroll down button, and you're going to scroll down and you're just going to look at the levels and the description. And you want to make sure that everything you see right here is here. If you see something in your Fibo levels that is not on this list to the right, delete it. So all you do is click on that level and click delete, and it will be removed. Now, there are two levels that is not going to be default for you. And these levels you're going to have to manually put into it. So what you're going to do is you go to the bottom, you go to the last fib, and you're just going to click the add button. When you click the add button, you're going to double click in the level box, and you're going to type in negative 0.27. And in the description box, you're going to double click and you're going to type TP. TP stands for take profit. So this is going to be take profit levels. You're going to add another box. You're going to put in the level negative 0.618. And in the description, you're going to type in TP2, take profit 2. So what we're going to be able to do is not only are we going to be able to know when price action after a pullback will reverse and go back to the trend, but we also can get an idea of how far the price gonna go beyond the lowest trend point. So once it's trending, how far could it possibly go where people in the markets are going to be starting to take profit, and you're going to be using them as take profit areas. So I'm going to show you just a second how that looks. So again, we're looking at NAS. Okay. So if I'm looking at the NAS chart, let's say, I think this is a 5-minute. I got this H1 here, but this is a 5-minute chart. And so obviously there was a breakout. And if you missed the breakout, you waited for this little pullback right here to draw your fibs. So in this example, I would draw on my 5-minute chart from the top, which is the high right here, and my bottom, okay? So this is the high. I waited for my pullback to draw the fib. This is where my fib is drawn to. This is the low right here. Not down here, right here. Okay, it always stops at the candle when the reversal pullback was about to happen. So this was the high and this was the low prior to this pullback. So I'm going to draw here, here. My fibs come out my window. What am I waiting for? I'm waiting for price action to come in my 50 to my 61.8 window up here. Okay, I'm looking at the 50. NASDAQ always hits 50. I don't know why. Sometimes it do 61.8, but a lot of times the 50s hit. Okay, so in this example, I'm looking for opportunity to short. So I'm shorting in this area. Right? Price action goes down. That's what you see here. Price action goes down. And what is it going down to do? It's going to test the original low of the market. What else can it do? Where can it go after it breaks the low and continue to go down further? Well, that's why we set up our take profit levels. So 9 times out of 10, once price action breaks this 23.6 level, it's probably about a 75% chance that it's going to hit your first take profit. It's no guarantee that it's going to hit the second take profit, but there's a 70% chance that it will hit the first. So if you're shorted from this area, you literally holding it open, waiting for this take profit here to happen. And they're going to do all this messing around, but eventually they're going to hit that take profit. That's what you see. So if you were trading as the day, and if you knew how to draw Fibonacci lines, this is exactly what you saw. Okay, it's right here. And then it would have to be more volume in the marketplace to push it down here. But this take profit is when I'm usually out of the trade. I will be out of the trade. Okay, so if you missed the breakout, so wait for the pullback. I want my pullback to be as close to the 50 and 61 as possible for me to even consider shorting. And hopefully it's hitting a moving average. Then I'm going to short and I'm holding it open, waiting for it to hit my take profit. And especially if it breaks the 23.6. Now, if price action comes to the 0 point and it stays there, like it literally starts consolidating on the 0, it is a good probability that it is not going to hit that take profit. It's probably going to reverse and push back up. So you can still close out your position at the 0. And even if it did go down to the take profit, you can actually use this take profit as a way to do a quick scalp buy once it hits and wicks off of the take profit. Okay, so that's really what this is. I'm giving you your Fibonacci's. You know how to draw from high to low to high. And then your take profit 1 and your take profit 2 is there for whenever the market starts trending in the original direction. This is off of a 5-minute chart. You can draw fibs on any time frame. You can draw fibs on a daily. Now, obviously, if it's daily, you swing trading, I wouldn't recommend doing that, but you can kind of see, do it off the daily and see where the 50 to 61.8 level is and draw it on lower time frames. You can do that, but I don't draw fibs on a daily. Okay, some people draw their fibs on the hourly. At the end of the day, we all going into the same place. We just might be going in different directions because each time frame may be in a different direction when you draw the fib. But we all end up at the exact same place. So I draw off my 5-minute because my 5-minute with my fibs never does me wrong. I hit every time, and especially with my critical points. always hit, okay? Let's say I'm looking at an hourly. Now, the funny thing about the hourly is the hourly would have helped you get in that counter trade at the top. Because look at this. If you drew from, let's say you drew from this bottom and you drew it to this top because of this pullback. Let's say you use this one. You could use this one, or you could have went from here to here. It doesn't matter. But I'm just using this example. Maybe this hadn't happened yet for you, okay? So you drew from here, and then when you start to see a little pullback, you drew from the top, the bottom to the top right here. When you did that, it gave you the levels. So what was happening is you literally would have been waiting for price action to come down to the 50 to 61 area. Well, obviously that took time because price action went up and it hit the first take profit. But then look what it did. It did fall back down and it did hit your 50. And what happened after that? It reversed back up, hit take profit a second time. So you still can win. It's just depending on how you're reading the charts. Everybody reads the charts different. Everybody trade on different time frames. You find the time frame that works better for you and your nerves, and that's what you master. Just remember, draw your fibs after a pullback. And so in this case, price action hit take profit actually twice. And both times when it hit take profit, you could have did a quick scalp reversal down to the downside. Okay, so I hope this helped people. You see a lot of people, like you might hear Atricia say it hit my take profit. You might hear Cinta say it hit my take profit. You might hear Q say it hit my take profit. You might see Damar say it hit my take profit. They're using fibs. And depending on the time frame that you're using is how your fibs are going to look. But at the end of the day, price action follows math. When big money is trading, they're going off of math. They are using Fibonacci. So you already have automatic Fibonacci's on your chart. Look at the lines here. This is your automatic Fibonacci. So even if you don't know how to draw fibs, it was right here. Look at this. It's already on fib. You see it? It's there already. Okay, so even if you don't know how to draw fibs or you don't use fibs, you're still better off than majority of people in the world because you know your price points. And now that I've taught you how to draw your critical points, it is always going to be money. You see my critical points right here? That white line, look at that. Money, short, money. Go back and retest it, money. Look at this, buying off my critical point, money. It's money because it hit the 50 on its way to the 61.8, but where did it stop? My critical line, reverse, buy, went all the way up to the top. Money. So I want to give you guys some quick tips. And I always look at everybody trades throughout the day. You all have been doing an amazing job, especially all the new people that have got in, got their chart set up. Y'all trade, y'all rock. I'm so proud of you. You continue to keep practice trading. Here's what I need everybody to stop doing. Stop trading large lot sizes just to see big money. That's not realistic. That ain't gonna be your life. Unless you putting $3,000 and $5,000 in your trade account, ain't no reason to be trading 1.0 lot sizes. You should be trading lot sizes based on the money you're going to be putting in your account so it's realistic, so that you don't set unrealistic expectations. If you trade big lot size and demo account and you making $2,000, $3,000, $4,000, but then you only putting $300 in your account and you making $13 and $20, you mad, I ain't making a lot of money. So what you do is you overtrade and then you start losing that money and then you blow an account. I need y'all to trade realistic lot sizes. You also don't have to overtrade. If you're sitting back and letting the markets come to you, you ain't got to get in and out and in and out and in and out and taking 10, 15 trades in a day. You can take 3 to 5 good trades, 3 the most. And all you got to do is increase your position size when you catch a breakout trend. But over trading will lose to you losing your money. Stop trading in between the moving averages. If the candles are not below it or above it, don't trade. Stop trading against the trend. Stop counter trading unless you got the 3 confirmations there. If you ain't got the 3 confirmations, don't counter. Stop rushing to go live. I don't care if you've been demo trading and you've been getting some luck and you've been hitting every time you trade, don't you go live. Do not rush to go live until you understand the entire concepts and you can truly look at the charts and you can see exactly where it's going. Because here's the thing, if you go live and you scared, the moment that you go live, you're not ready to go live. When I went live, I had 0 emotion. I knew what I knew. I was confident in knowing what I know, and I was going, and I'm trading. If you go live and you're scared, you lose a little bit of money live and you more scared, you wasn't ready. Stop rushing. This ain't a competition. Take your time. The markets ain't going nowhere. They're going to be here next year, 2 years, 5 years from now. The market's still going to be here. Stop being emotionally tied to money. You are going to lose money. There's nobody that trades and win 100% of the time. If they tell you they do, they lying. I still lose money to this day. And I'm better than all y'all, but I still lose money to this day. But I'm not emotionally tied to it. So when I lose, I don't lose a lot of money. I lose a little money. And then I sit back and wait. And then I make my money back. It never fails. And so if you get a loss and you upset and you losing in demo, like you ain't even losing real money, but you upset. You're not ready. You're not ready. Because when you lose, it should be a learning experience. Be like, all right, I lost this. All right, let me get back on. Let me do what I need to do. And you'll see that you'll start to make that money. You will have to lose back to back to back 25, 30 times in a row to blow an account if you're trading on a low lot size. So don't get emotionally tied to it. While you working your job or whatever you're doing and you income shifting, you put a little money every week into your little trade envelope. So you can get ready to start trading live. And when you're ready to trade live, you got a nice bulk of money to be trading with. Don't rush. What I do want you to do is I want you to look at that economic calendar every day so you'll know if it's some news announcements that can affect what you think was going to happen for the day. Study your charts every day, even if you don't trade. Look at the candles, how they move in respect to the moving averages, to the resistance and support, and to your fibs. Take a practice strategy trade every day, win or lose. You learn with losses. Like I said, journal your trades so that you can see what the market looked like when you was winning. So when you see it again, go ahead and take it. Review your old trades every day so that you don't keep making the same mistakes. And speak life over your trade every day. I know on my team, we're doing a 30-day challenge. Where every morning we waking up, we praying, we meditating, we saying our affirmations, we getting our mind right so that you have this positive mindset. You ain't got nothing bothering you. Don't trade when you don't feel good. Don't trade when you upset. Don't trade when somebody getting on your nerves. Only trade when you in a nice, peaceful place. You got the goal, you focus. If you can't focus, don't trade. But we speaking life over our trades. Every time we take a trade, we're gonna win. That's what we speaking. We see money today. I'm gonna grab money today. Every trade that I take is going to be the right trade based on the strategy, and I'm going to win today. That's how you speak life over your trades. I got money coming to me in so many different directions. I don't know where it's coming from. I'm trading Forex, futures, stock options, stocks, crypto, all at the same time. Yes, money is everywhere. That's how we speak life every single day, and that's what you got to do. So stop the excuses, stop procrastinating, stop not doing what you need to do, because this is going to give you a sales skill set that is going to change your life. Your homework is I want you to practice just drawing fibs. I want you to make sure your fib settings are set up correctly based on what you saw in this training today. I want you to practice drawing fibs. Wait for a trend, wait for a pullback, and then draw from high to low or low to high, and just look at how the candles react to these areas. And then when you see price action hit the 50, 61, wait for some reversal candles and take the trade and test it out and continue to drop your screenshots into the group. All right, y'all. I think I'm done. I think I'm done. And I still went 2 hours, y'all. I told y'all we weren't going to be here 2 hours. And we still here true hours. Let me do my screen one more time. Right here, somebody asked how to draw resistance and support. You go to your demo account or whatever, and right here in your toolbar, you should see something that it looks like a horizontal line. Okay, if you don't see it, you can go to inserts, you can go to lines, and you can go to horizontal lines. Okay, so again, if I'm on my daily, oh, I already got the resistance and support, but let's say I want to draw some more resistance and support right here. I'm just going to click this horizontal line and click the bottom of this area. Now I got another one. I can click my line again, draw it on the top here. I got another one. Okay, and you just do that. That's all you got to do. All right, however you want to do it, draw it at the top. Okay, and that's if I was doing my daily. If I went down to the 5 minute, it's right here. Okay, let's say I wanted to draw, I don't know, where am I looking at? Well, I wouldn't draw fibs now because as you can see, the market is literally ranging right now. So you wouldn't draw any fibs right up in here. It's not trending. It's moving sideways. Here, obviously, again, you could tell it was a trend. If I'm drawing my fibs, the same like I showed you in the training, I'm going to go right here to the logo where it says draw Fibonacci's. If you don't see that right here, you go to insert Fibonacci retracement. That's all you got to do. When I clicked it, you see my little cursor here. I'm going to go to the top and drag down. And I'm going to the bottom right where the candle reversed and started to wick up for the pullback. So I will literally draw it right here. Okay. And then I will wait for price action to go up to either the 50, 61.8 and reverse down. Once you start reverse down, I'm going to short and I'm going to hold it open to my take profit level. But if it go to the 0 and it just starts stalling, close out at the 0. It's okay. And even if it go down to the take profit, I would have did a buy here, take profit, buy here, take profit. Let's see what it's doing, because right here you see it went up and then it's creating lower lows. So it might go down, and if I move this in, maybe sometime tonight, it might come down and hit my take profit too. Okay, it might hit that. If this area is a take profit, you see my critical line up in here. So this might be area, you might see a box up in here. So this will be some areas where I will be interested in going long if price action comes down tonight and retest this level. Or price action could buy off this take profit once again. Okay, so you just have to sit back, be patient, and literally let the market come to you. All right, you guys. Okay, we are done. We are done. So again, do your homework, and I will see y'all guys next week. This seems like it's been a long trading class. Next week, we're gonna go over the what I call it. I think it's the flag or ATB indicator, and then I'm also going to show you the indicator that you guys are going to be using to trade a consolidated market. So I'm going to introduce you to another indicator, and then also a trend indicator. I thought I added it. I might not have added it, but I found a little trend. Hopefully I found this trend indicator. I think that will draw a trend line for you, which will just help you stay focused on trading with the trend and how to trade a trend line. Okay, so we'll go into that next week, and then after that, our last session, we are done. We're done. I'll probably come back again that next week for like a Q&A, and all you got to do is keep watching the videos, keep practice trading, and then you're gonna be ready to go live. All right, so y'all have a wonderful and a safe weekend, and I will see y'all next week. Good night. Good night. Good night. Good night.